Dear learners, now let's come to our next inventory key performance indicators, and this is called as gross margin return on inventory investment. The acronym for this KPI is GMROI. Now what is GMROI? So basically this metric is actually linked to the concept of return on investment. So when we talk about return on investment, we basically see what return we get on the investment that we do. And the same happens in the context of inventory. So as far as investment in the inventory is concerned, we already seen that the average inventory concept, which talks about the value of inventory in the particular period. And that value of inventory is nothing but the investment in the inventory, because we are keeping that inventory either in the form of safety stock or either to meet future demands of the customers. And because we are keeping that in a stock, that means our money or our cash flow is blocked in the form of investment. Now we have to understand against this investment what benefit particular product or particular product line gives to the business. And that is what GMROI talks about. Now let's define the concept of gross margin return on inventory investment. So GMROI is a metric that indicates businesses about how effectively a company generates gross margin from its investment in the inventory. And that's why it is basically considering gross margin as one of the parameter in the calculation and also the average inventory. So let's talk about the formula of GMROI. So GMROI equal to gross margin divided by average inventory. Now what is gross margin? So gross margin is basically a profit, and profit is calculated as sales value minus cost of goods sold. So it is very simple to understand what is the sales value, which is coming from our ERP system or even our records in the financial systems. And we also know how to calculate cost of goods sold. So once we subtract cost of goods sold from our sales value, we get gross margin. And that is basically sales minus cost of goods sold divided by average inventory as a ultimate formula. Now let's talk about some examples of 5 different product numbers. So here in a table, you will see there are 5 products. The first is A001 and the last product is A005. Now for each product, we have directly calculated a gross margin based on the sales and cost of goods sold. And then we also calculated average inventory of these products in a particular period. So in these two columns, you already have a data of gross margin and average inventory. And then when you have to calculate GMROI, you have to just divide your average inventory to the gross margin. And if you see in this table, the product A005 has the highest GMROI. That means this product is performing much better compared to other products. And that is why if our GMROI is on a higher side, the performance of that product is better. And if the GMROI is on a lower side, then the performance of that product is poor. So let's consider another example of product called A002. In this case, you can see the gross margin of this product is 20,000 and average inventory that we keep is 23,000. That means the average inventory is on a higher side, and that indicates us or inventory manager to control on the inventory or to control on the prices. And if such products are continuously on lower side of the GMROI value, it is very important to understand why the products are not performing well. Either they are not meeting the functions or characteristics that customer is expectation, or they are not at par with their prices compared to the competitor, or you may have higher inventory built in your facilities, and further actions can be taken by inventory managers in collaboration with sales team, product management team, or even supply chain leadership team. So ideally, higher the GMROI, better the performance of the product line or the company.